What if you could get paid every single year by some of Singapore's safest and most established companies, without lifting a finger? Well, if you've been holding shares of DBS, UOB, or OCBC, you're smiling right now, because all three banks recently announced higher dividends, again. But before you go out and buy bank stocks blindly, I want you to stick with me till the end. In this video, I'll show you how these banks actually make money, in plain and simple terms, the latest results from each bank, and most importantly, are they still worth it as long-term dividend investments? Oh, and quick reminder, this is not financial advice. It's just my personal breakdown for educational purposes. Always do your own research or speak to a licensed financial advisor. If you like this kind of content, please take 2 seconds to like this video, subscribe to WealthForYou, and comment below to support the channel. It really helps more people find this info and build their own passive income. Chapter 1. How Banks Make Money. A simple explanation. Before we jump into the results, let's get back to basics. How do banks make money? It's actually very simple. Think of banks as the heart of the economy. They collect deposits from people like you and me, pay us a little interest, maybe 2%, and then lend that money out at a higher rate for housing loans, car loans, or business loans. If they lend it out at, say, 4%, the difference is the bank's profit. But that's not all. Banks also make money through credit card fees. Every time someone swipes a card, the bank gets a cut. Wealth management, helping customers invest and managing big portfolios. Insurance, where banks either own or partner with insurance companies. This is why banks are called hybrid stocks. They offer slow but steady growth. They are cyclical, meaning they follow the ups and downs of the economy. But most importantly, they pay consistent dividends, perfect for long-term investors. Chapter 2. UOB, Growing for the Long Game. Let's begin with UOB. UOB recently made a big move by acquiring Citibank's consumer banking business across several countries. This is a smart play because it immediately boosted UOB's billings by 12% and wealth management business by a huge 30%. But Q4 wasn't perfect. Profits fell about 5% quarter-on-quarter, and fee income also dipped. However, this is pretty normal for banks during the year-end when things tend to slow down. Looking at the full year, UOB did well. Profits grew, deposits increased, with CASA, i.e. their low-cost savings accounts, up 19%, which is fantastic because it gives UOB more cheap funds to lend out. They increased their dividend from 88 cents to 92 cents. Plus, they threw in special dividends and a whopping $2 billion share buyback. So what does this all mean? UOB is playing the long-term game, expanding across ASEAN, growing its customer base, and still rewarding shareholders with attractive dividends. Chapter 3. OCBC, Quiet Strength with a Focus on Insurance. Now, let's talk about OCBC. While OCBC may not always grab the headlines like DBS, they are quietly getting stronger. This year, they reported an 8% increase in net profit, with both interest and non-interest income growing. One of their biggest moves was fully privatizing Great Eastern, their insurance arm. This means more control and, importantly, more long-term profits. Their wealth management fees also jumped 22%, showing that OCBC is steadily growing its base of customers who trust them to manage their wealth. Yes, expenses did go up, partly because they invested in their people and also due to the acquisition of PT Bank Commonwealth in Indonesia. But here's the thing. These are the kinds of expenses you want to see. They're investing for future growth. And shareholders? They were rewarded. OCBC raised its dividend payout ratio to 60% of profits, announced a $2.5 billion capital distribution including share buybacks, and currently the dividend yield is about 6.1%. For a bank as conservative and stable as OCBC, That's a very respectable yield. And with a stronger insurance and wealth management business, this income stream will likely keep growing. Chapter 4. DBS, still the champion. And of course, we can't forget DBS. DBS continues to dominate, posting a massive $5.5 billion profit this quarter, easily the highest among the three. Its net interest margin came in at 2.77%, leading the pack, which means it's still earning more on its lending than its competitors. DBS also delivered the strongest return on equity at 17.2%, meaning they are using shareholder money more efficiently than anyone else. What gives DBS an edge is its growing non-interest income, now making up 32% of total income. This is crucial as we move into a period where interest rates may start falling. Banks with diverse income streams will weather it better. Despite higher operating expenses and other typical headwinds, DBS still announced higher dividends, showing that they are not just surviving, but thriving. If you're looking for a bank that has scale, innovation, and the ability to generate reliable cash flow, DBS is still leading the way. Chapter 5. Why these banks are still great for passive income. So, are these banks still good choices for passive income? The answer looks positive, and here's why. These banks are essential pillars of Singapore's economy. As long as people borrow for homes, businesses, and cars, these banks will remain highly relevant. Their balance sheets are rock solid, with strong capital ratios well above global standards. They are committed to paying dividends, consistently distributing between 50 to 60% of profits back to shareholders. Even if interest rates decline over time, the bank's growing income from wealth management, insurance, and credit card businesses will help sustain and potentially grow dividends. Most importantly, these are not just dividend-paying stocks for today. They are businesses designed to last, adapt, and reward shareholders consistently for many years to come. Chapter 6. Comparison of the three banks. To sum it all up, here's how the three banks stack up against each other. DBS remains the clear leader. It offers a dividend yield of around 6%, but what really sets it apart is its impressive return on equity of 17.2%, the highest among the three. DBS also has the strongest wealth management division, which gives it an additional edge, especially as interest rates start to soften. Its ability to consistently generate strong profits while diversifying income makes it a powerhouse in the region. UOB, on the other hand, offers a slightly higher dividend yield of about 6.1%. What makes UOB interesting is its ongoing expansion across Southeast Asia thanks to the recent Citibank consumer banking acquisition. This move has already boosted its wealth management and billing businesses significantly. UOB's return on equity stands at 13.3%, and with its expansion strategy, there's potential for further growth down the line. OCBC is also offering a healthy dividend yield of about 6.1%. What differentiates OCBC is its strong insurance and wealth management business, especially after fully privatizing Great Eastern. Like UOB, OCBC's return on equity is around 13.3%, but its strength lies in its diversified income streams, especially from insurance, which helps cushion against interest rate risks. So while DBS currently holds the crown for profitability, UOB and OCBC are making strategic moves to close the gap, all while rewarding shareholders with attractive and sustainable dividends. So whether it's DBS with its strong profitability, UOB with its regional growth strategy, or OCBC with its stable insurance and wealth income, each bank brings something unique to the table. But one thing they all have in common? They continue to be reliable income machines, making them a strong consideration for anyone building a long-term, dividend-focused portfolio. Final thoughts. So if you're looking to build a passive income portfolio, Singapore's three local banks, OCBC, DBS, and UOB, continue to stand out as some of the strongest and most dependable options out there. Reliable, dividend-friendly, and built to deliver long-term value. If you found this video helpful, support the channel by liking this video, subscribing to Wealth4You, and dropping a comment below. Which of these banks do you own or are planning to buy? Thanks so much for watching, and I'll see you in the next video.